Hi and welcome to another episode of Informed Investorr. This week has been quite the ride for investors, with volatility hitting the mid-cap and small-cap space particularly hard. But that's not what we're here to talk about. But if you're curious to know more about that, we've already covered this in a previous video. Do watch it. So let's dive into what we do have on the agenda for today's episode. The Ministry of Corporate Affairs has recently put forward the Digital Competition Bill, which has been opposed by many big tech firms. And we are going to break that down for you. Moving on, the SEBI chair has announced plans to kick off the T+0 trade cycle settlement. Now, what does this mean for investors, and what challenges might arise as we transition to this new settlement cycle? And last but not the least, there's been a buzz surrounding a major trade deal between India and the EFTA countries. What's all the fuss about, and what implications might this deal have for both parties involved? Let's delve into the details. Let's begin. You're watching Informed Investorr, an initiative by ResearchAndRanking. Healthy market competition is the cornerstone of a booming, growing economy. And according to basic economic principles, competition amongst firms drives down prices, boosts the quality of goods and services, expands consumer choices, and also gives rise to innovation. And these are just not economic theories, but realities we've also seen in action. However, when competition is lacking, dominant players can exploit their market power, leading to unfair practices. Let's talk about this. You see, unfair competition is a serious issue that we can't just sweep under the rug. Think about it. Competition is supposed to be this level playing field where businesses make it based on merit, innovation, and quality. But when unfair practices like, say, predatory pricing or monopolistic behavior comes into play, that playing field gets tilted and some players get an unfair advantage while others are left in the dust. And it's just not about the businesses, it's about us, the consumers too. Unfair competition limits our choices, drives up prices, and stifles innovation. In India, we've also seen instances of unfair competition. Amazon and Flipkart were investigated for giving special treatment to some sellers and offering big discounts, limiting choices for consumers. Now, Google also got in trouble for favoring its own services in search results, making it hard for competitors and limiting our choices. Now, Reliance, one of India's largest conglomerates, has faced allegations of anti-competitive practices. For instance, there have been complaints about Reliance Jio's pricing strategies in the telecom sector, which some competitors argue are aimed at driving them out of the market. Now, you might wonder if we have laws to address these issues and penalize such unfair practices. Well, indeed, India took a step in the right direction by enacting competition law back in 2003 and establishing a competition commission. However, there's a gap in our legal framework when it comes to the digital ecosystem. As of now, we lack specified laws tailored to address the unique challenges of digital markets. And our digital market is rapidly growing. India has approximately 350 million online transactors across e-commerce, shopping, traveling, hospitality, which is expected to grow 2 times by 2030. Now, with such growth, it becomes important to have regulations in place. So the Committee on Digital Competition Law, formed by the Ministry of Corporate Affairs, has proposed a new digital competition bill and prescribed ex-ante regulations. So what does this mean? The bill brings in additional compliance requirements for major technology companies. These companies are big players that offer core digital services like search engines, social media, video sharing platforms, etc. Now, these kind of companies are what this law is focusing on, and they're also putting them under systematically significant digital enterprises, or SSDEs for short. Now, if a company falls under this category, this law will bring in some extra rules that they have to follow. First off, they have to declare themselves as an SSDE based on the things like how much money they make globally, how many users they have in India, and other factors. Now, once they've been classified as an SSDE, there are new obligations they have to meet. For example, such companies can't give unfair advantages to their own products or services, or to products from companies they have connections with. They also can't use data from businesses that use their platform to give themselves an edge against them. Plus, they can't stop users from using other apps or services on their platform, like if they were trying to force them to only use their stuff. Now, if a big tech company falls under this category, it also can't give special rewards or perks to users or businesses to use more of its own products or services. And it's just not about the company itself. It also includes any other company it's linked to or has partnerships with. Now, if a company is found to violate these competition laws, they could face fines of up to 10% of their global turnover and even imprisonment for up to 3 years. Now, introducing a digital competition bill means introducing ex-ante regulations. But what does that mean? Well, currently we typically deal with anti-competitive practices after they've already happened or post-ante. However, under an ex-ante framework, the law would set out rules and guidelines an SSDE has to follow before any unfair practices occur. It's worth noting that some major tech firms like Apple, Amazon, Bundle Technologies, Swiggy, Flipkart, and Google have expressed opposition to ex-ante regulations. Now, companies like Naukri.com, Policy Bazaar, Book My Show, Zomato, and Swiggy collectively dominate their respective domains. And if classified as large platforms under the Digital Competition Act, they would be subjected to restrictions that could hamper their ability to offer competitive products and services, potentially affecting their market share and growth. Now, some observers also fear that these laws might hinder innovation in our country. Startups in particular could face a heavy compliance burden, and there's a worry that law enforcement officers might overly pursue violations without due consideration. So while the intentions behind the digital competition bill are commendable, it is crucial to strike a balance and ensure that the regulations don't hinder the innovation spirit of Indian businesses. Now let me break down the concept of settlement cycle for you. So when you buy stocks, it's the gap between making the purchase and officially owning those shares. Now this duration, typically spanning a couple of days, is referred to as the settlement cycle. Now the cycle's length can vary depending on your location and the type of securities you're trading. In the US, for instance, it's usually T+2, meaning 2 business days post the trade. Now, the whole point of having a settlement cycle is to ensure that everything is accurately recorded and securely transferred. Now, some countries are also working actively on shortening the cycles to make transactions even faster and more efficient, and India is one such country. Now, SEBI has made significant progress by transitioning to a T+1 settlement cycle earlier this year. Now, this move positioned India as the first major market after China to implement this impressive T+1 cycle, even ahead of major markets like the US, UK, and Japan. Now, before this shift, India used to operate on a T+2 settlement cycle, and back in the early 2000s, it was even a weekly settlement. And before the National Stock Exchange was established in 1994, Bombay Stock Exchange followed a fortnightly settlement system. Now, imagine waiting for 2 whole weeks. Now, in a bold move, SEBI announces plans to introduce the T+0, which is a same-day trade cycle settlement, on an optional basis by March 28. Now, with T+0, settlements happen on this very same day, ensuring trades are settled immediately. But is India the only country adopting same-day settlement? Not quite. Countries like Russia, South Korea, Taiwan, Hong Kong have already embraced this settlement, but for only specific securities. Now, moving to a T+0 settlement in India offers several perks. Firstly, it slashes the risk of one party defaulting on a deal because transactions are settled immediately, making the market more steadier. Secondly, it frees up cash faster since settlements happen quickly, meaning investors can put their money to work sooner. Now, moreover, it boosts liquidity because investors can swiftly reinvest the funds from completed transactions, keeping the market flowing smoothly. Additionally, it also makes the market more efficient by cutting down the time it takes for transactions to settle, making trading safer and more efficient. Also, faster settlements build trust among investors since deals are concluded swiftly and transparently. And let's not forget about the savings. Shorter settlement cycle means lower cost for things like margin requirement and managing collateral. And what's more, quicker settlements could draw more traders and investors, leading to a more livelier market. Now, while moving India to a T+0 settlement where trades settle instantly sounds great, it's not as easy as flipping a switch. Now, there are hurdles to overcome. Let's discuss that. First off, our current systems may need a big upgrade to handle the speedy settlement. Plus, there's more risk of mistakes and system failures with such quick transactions, so we would need to beef up our processes. Also, making sure there's enough money flowing around to handle instant settlements could be tough, especially for smaller players. And we'll also have to tweak our rules to fit this new way of doing things. But if we can tackle these challenges, it could make our markets more efficient and more faster, benefiting everyone involved. Overall, SEBI's move to implement the T+0 settlement aligns India with global financial standards, and you can also view it as a testament to India's dedication in advancing its financial landscape. Global interdependence is a reality. Nations rely on trade to fulfill their needs. Now, this reliance on trade stems from the simple fact that no single nation can claim complete self-sufficiency. Instead, each nation must engage in trade to access resources, products, and expertise. But here's the catch. Some countries set up barriers to this trade. Now, these barriers come in the form of import and export tariffs, basically taxes on goods coming in or going out of a country. Now, these tariffs can make trade more expensive and more complicated. Now enter the Free Trade Agreement, or FTA for short. Now, a free trade agreement is an agreement between two or more countries to reduce or eliminate barriers to trade between them. Now, this agreement aims to create a more open, more efficient trading environment by significantly reducing or eliminating government-imposed barriers. Now, by lowering barriers, FTAs can encourage more buying and selling of goods and services between the FTA partners. Now, this can lead to economic growth for both sides. Also, FTAs can attract foreign investments, and additionally, increased exports can also create jobs in export-oriented industries. Now, FTAs with developed countries can also facilitate the transfer of technology and knowledge. This can also help companies become more competitive in the global marketplace. Now, what is India's story when it comes to FTAs? Now, for most of its independent history, India was cautious about international trade agreements. Negotiations were slow and many deals stalled. However, in recent years, India has become more active in pursuing FTAs. India has signed various free trade agreements with different world economies to boost trade and economic cooperation. After nearly 16 years of negotiations, India and the European Free Trade Association, comprising Switzerland, Norway, Liechtenstein, and Iceland, signed a historic trade agreement. The EFTA members are not part of the European Union, do know that. Now, this is India's fourth such agreement since 2014, and the previous agreements were signed with Mauritius, the UAE, and Australia. Now, India is also negotiating FTAs with the United Kingdom, the European Union, and the Gulf nation of Oman. Now, this pact between India and the EFTA, known as the Trade and Economic Partnership Agreement, marks a significant milestone for several reasons. Let's see why. Now, this agreement is India's first free trade deal with a bunch of developed countries. This is a big sign that India's economy is growing strong and they're looking to team up more closely with these leading nations. Now, India and EFTA already had a strong trading relationship worth $25 billion a year, making India EFTA's fifth biggest trading partner after the European Union, the United States, Britain, and China. Now, the solid base makes it even easier for both sides to benefit from the new agreement. However, India has a huge trade deficit with other countries in the EFTA. In fiscal year 23, the trade deficit for India was about $14.8 billion. Now, EFTA also brings a wealth of experience to the table, having signed over 30 trade deals with other countries. Now, India is also putting forward a significant offer in terms of tariff reduction. That's a pretty big deal because it means a vast majority of the products traded between India and the EFTA countries could potentially become cheaper due to reduced tariffs. Now, with the FTA in place, people who love to consume Swiss chocolates and biscuits will definitely rejoice, as the deal will reduce the import duty on these. Now, duties on a substantial number of goods imported from EFTA countries such as watches, smartphones, olive oil, cornflakes, machinery, textile, medicines will be phased out. However, when it comes to agricultural items, it seems India is playing it safe. Most agricultural products are not included in this deal. Now, this could be for various reasons, such as protecting domestic farmers or because these products are subject to different trade regulations altogether. But it's just not about goods. The services sector is also a crucial part of this agreement. The government of India is also looking forward to cooperation in fields like research and development, banking and financial services, digital trade, biotechnology, clean energy, etc. This trade agreement goes beyond just lowering trade barriers. It also includes a significant commitment from EFTA countries to invest in India's future. They pledge to support India's economic growth by aiming to increase foreign direct investment of $100 billion over the next 15 years. Now, this substantial investment is expected to create 1 million new jobs directly within India, further boosting our economy. Now, while the trade agreement is a big plus, India and EFTA countries will need to work together to make sure investment flows easily and businesses have what they need to thrive under the agreement. If everything goes well, this agreement could be a game changer, boosting economies and creating prosperity for both India and the EFTA countries. Having said that, this is me, Merlzana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.